This is a video on accounting changes and error corrections. And this is a good video to study because one of the traditional areas that is tested on the CPA exam is the candidate's knowledge of how to account for the effects of a change in accounting principles, estimates, or error corrections. So you should be prepared to see some questions that ask how to handle each of those aforementioned items I just talked about. That'll be either by describing the accounting for, calculating the requested amounts, or choosing the correct journal entries. So accounting changes, error corrections is based upon the premise that accounting must produce financial information that has the qualities of comparability and consistency. Entities must not just make arbitrary changes in accounting principles unless they can be justified as preferable. So therefore, the general or the golden rule, so to speak, in looking at accounting changes is that the presumption is that an accounting principle, once adopted, it's got to be applied consistently when we're preparing financial statements. Now, there are three categories of accounting changes and errors that can occur within financial statements. The first one is being what we call a change in principle. The second one being a change in an accounting estimate, and the third one being an accounting error. Now, a change in accounting principle is when basically the organization adopts a generally accepted accounting principle that's different from the one that was previously used. Also, it can include changes in the method of applying the principle itself. Even though we didn't change the principle, we changed something in the method of applying the principle. Number three, then, changes to generally accepted accounting principles when the previous GAAP is no longer a generally accepted accounting principle. Right now, to summarize change in accounting principles, this requires the retrospective application of the change in the accounting principle, and we'll get into that in more depth in the next slide. We also have a change in an accounting estimate, and the change of an accounting estimate is the reassessment of the status and benefits, which are basically the benefits and obligations of assets and liabilities, and that's usually based upon new information that has become available to the entity at a particular point in time. Under these conditions, a change in accounting estimate is going to require what we call prospective application on the financial statements. The third area is what we call an accounting error, and that can result from a mathematical mistake or a mistake in the application of a particular accounting principle, or the oversight or misuse of facts when statements are prepared. Now, if something falls into the category of an accounting error, it's going to require retrospective application. So let's go ahead and dive a little bit deeper into each of these three categories. We're first going to talk about the change in an accounting principle. Okay, as a reminder, a change in accounting principle occurs when an entity adopts a generally accepted accounting principle that is different from the one that we'd previously used. Or number two, it changes the method of applying the generally accepted accounting principle. Or number three, changes to a generally accepted accounting principle when the principle that was previously applied is no longer generally accepted. Now, examples of this, of the change in principle, would be to adopt a new authoritative body standard, a change in the method of inventory costing, a change in the method of bad debt valuation, a change from completed contract to the percentage of completion for recognizing, as an example, revenue. As I previously mentioned, retrospective application is required for all the direct effects and related income tax effects as a result of the change in principal. This also means that the carrying amounts of assets, liabilities, and equity, in effect retained earnings typically, basically at the beginning of the first period reported to be adjusted for the cumulative effect of the new principal on prior periods. And all periods presented must be individually adjusted for period-specific effects of the new principal. One of the problems is that in some cases it may be impractical or impossible to determine the cumulative effect of the new principal on any particular prior period. In that case, the new principal must be applied as if the change had been made prospectively at the earliest date that is practical. It also may be practical to determine the cumulative effect of applying the new principal to all periods, but not period-specific effects on all periods presented. In circumstances like that, cumulative effect adjustments must be made to the beginning balances for the first period to which the new principal can be applied, and then we use a basically prospective approach. Now, it does also require a series of footnote disclosures, and I've listed some of the major ones here. In year of accounting principal change, the reason for the restatement, a description of the prior period financial statement information that was retrospectively adjusted, the effect of the change on income, EPS, and any other financial statement line item that was retrospectively adjusted, and the cumulative effect of the change on retained earnings at the beginning of the earliest period presented. If comparable financial statements are also presented, note respective changes have been applied to all the comparative financial statements presented. If prospective changes cannot be made, footnotes should contain a statement as to why the retrospective change cannot be made. So now that was a change in accounting principle. Let's take a look at our next item, which is change in an accounting estimate. Now, again, a change in accounting estimate, as I'd mentioned, results typically from new information. It results in a reassessment of the future status of the benefits and obligations associated with assets and liability. Its effects must be accounted for only in the period of the change and then future application. In other words, it requires prospective application, and as I say, change is calculated in the year of the change and the effect is applied to future financial information. Now, examples of this would be as basically change of depreciation methodology, change of useful life or salvage value of a depreciable asset, changes to bad debt valuation, changes of actuarial estimates, changes of intangible useful lives or depletion base for natural resources. These are simply examples. They're not 100% of all changes in accounting estimates. They're simply some examples. Now, there can be a case where a change in an accounting estimate is literally inseparable from a change in an accounting principle. And remember, we said with an accounting principle, changes are applied retrospectively. Changes in accounting estimates, changes are applied prospectively. Now, if we do have a change in an accounting estimate that is inseparable from a change in accounting principle, we need to account for that change as a change in estimate. In other words, that change in estimate will result in a prospective application. And again, that could be an example. That could be a change in a method of depreciation, amortization, or depletion. We also have a series of footnote disclosures. When we do the change in accounting estimate, they're typically a little simpler than the change in accounting principle, but this would include description and reason for the change in year of accounting estimate change, and the notation of accounting impact between the former and revised estimate. Now let's go on to accounting errors or error corrections. As I had mentioned earlier, error corrections typically result from three categories, one being a mathematical mistake, number two, a mistake in the application of generally accepted accounting principles, or number three, an oversight or misuse of facts existing when the financial statements were prepared. It's also important to point out a change to a generally accepted accounting principle from one that was not is not an error correction. It's not an accounting change. Now, in the case of an accounting error, it does require restatement of retrospective application. In other words, the restatement of previous financial statements. Any error related to a prior period that is discovered after the statements are issued must be reported as an error correction by restating the prior period statements. Restatement requires that the same adjustments basically require the same adjustments as retrospective application of a new accounting principle, and that means the carrying amounts of assets, liabilities, and retained earnings at the beginning of the first period reported are adjusted for the cumulative effect of the error on the prior periods. Corrections of the prior period errors must not be included in net income. Error corrections error corrections must be reported in a single period financial statements as adjusted, basically the adjustment to the opening balance of our retained earnings. And if comparative statements are presented, corresponding adjustments must be made to net income and retained earnings for all periods that we're reporting. Also, you're aware that errors can be self-correcting in financial statements, meaning that in a particular reporting period, the error that had occurred had corrected itself. But we have to remember that those errors that occur as a result of prior period reporting, or show up in prior period reporting, those will result in possible material misstatements in the previous financial statements, even though the errors balanced out in the current year. Now, in terms of footnote disclosure, we have to make a reason for the restatement of the year, the accounting, in effect, we'll call it the accounting principle change, or basically the accounting error. Note retrospective changes have been applied to all comparative financial statements presented, and if respective changes cannot be made, we need to have footnotes should contain a statement why the retrospective changes cannot be made. Okay, let's look at question number one. And question number one is, how should the effect of a change in accounting estimate be accounted for? Again, you're given 4 answers. Study the question, select your, go ahead and then don't forget to stop the video and select your answer, and when you're ready, restart the video. Okay, number 1. The question is, how should the effect of a change in accounting estimate be accounted for? And you are given the answer being D, by prospectively applying the change to current and future periods. And if we take a look at some of our previous slide information, a change in an accounting estimate is, again, the reassessment of future status and benefits and obligations of assets and liabilities. That's usually based upon new information, and that requires a prospective application. Okay, let's try number 2. Centauri has failed to recognize accrued expenses for deferred bonuses for its employees in year 1. The amount of the bonus, the accrual before taxes, should have been $500,000. Centauri had a rate of 30% tax rate of 30%, and the question is, the company should adjust the beginning retained earning balance by, and you're given 4 choices. Go ahead again. Stop the video, do your recomputation or do your computations, and when you're ready, start the video and review the slide. Okay, number 2, the company should adjust the beginning retained earnings balance by, in this case it would be $350,000 debit, and it's based upon these facts. The net income for year 1 had been overstated by $500,000. Adjustment must be made, and again, we know this is net of tax, and in this case, the adjustment, we would have had to reduce our net income by $500,000. Again, net of our tax rate, the amount of the reduction should be $350,000 in income after taxes. Therefore, the beginning retained earnings in year 2 needs to be reduced by, or reduced by, which is a debit, $350,000. Okay, let's go on to number 3. Metro had incorrectly expensed a capital asset in the amount of $210,000 in year number 1. In the beginning of year 4, 3 years later, Metro discovered this error. The capital asset should have been capitalized with a useful life of 10 years and had a salvage value of $10,000. The company is subject to a 30% tax rate, so what should Metro report as a prior period adjustment? Okay, this is an accounting, this is basically a change in an accounting estimate. Let's take a look at the, well, before we do that, let's go ahead and stop the video, select your response, and when you're ready, restart the video. Okay, number 3, the company is subject to a 30% tax rate. What should Metro report as a prior period adjustment? In this case, the answer is C, $105,000. And what we need to do is calculate our adjustment to income. In year number 1, the reversal of expense would have been $210,000 since we expensed the entire machine. That should have never gone to expense. However, if we capitalize a machine, we would have had to recognize depreciation on the machine for years number 1 through 3. And the calculation is our $210,000 cost of the machine minus the $10,000 salvage value divided over 10 years. That equals $20,000 per year of depreciation. The $20,000 per year times the 3 years equals $60,000 to get us up to the beginning of year 4. So the net change to net income, in effect, netted out to be, we would have to increase our net income retroactively, or at the beginning of year 4, by $150,000. Now we also have to take in the tax impact of that change, and our increase in net income would have been $150,000, but we have to net out our tax effect, which would be $150,000 times 30%. So the net adjustment to retained earnings for the beginning of year 4 would be $105,000. Okay, let's take a look at question number 4. Topco purchased a machine in year 1 and calculated depreciation using the sum of the year's digits. At the beginning of year 3, the company changed their method of depreciating from sum of the year's digits to straight line depreciation. The machine had a cost of $240,000, a 10-year useful life, and an accumulated depreciation of $86,400. So what is the depreciation expense on the machine for the end of year 4 under this circumstance? Again, go ahead and stop the video, When you are ready with the answer, go ahead and restart the video for the answer. Okay, the answer to question number 4. What is the depreciation expense on the machine for the end of year 3? And the answer in this case is A, $19,200. The net book value of the machine at the beginning of year 3 was $153,600, which is the cost of our machine of $240,000 minus the $86,000 of accumulated depreciation. Therefore, with the accounting estimate, now we're going to change that to an 8-year. We're going to now change that to an 8-year life, since we've used up 2 years out of the 10-year useful life, since we're switching to straight line depreciation. So we're going to take the carrying value, or in effect the net book value of the asset of $153,600 divided by its remaining useful life. Now that we got into straight line depreciation, that will be 8 years. So the depreciation per year will be $19,200 at the end of year 3. Okay, let's go on to number 5, which will be our final question for accounting changes and error corrections. The effect of a change in accounting principle that is inseparable from the effect of a change in accounting estimate should be reported. And again, you are given 4 different choices. Go ahead, stop the video, make your choice. When you're ready, restart the video for the solution slide. Okay, number 5. The effect of a change in accounting principle that is inseparable from the effect of a change in the accounting estimate should be reported as B, treating the change in the same way a change in accounting estimate would be treated. And we see from a previous slide we talked about basically a change in accounting principle and a change in an accounting principle, I should say, that is inseparable from a change. Separate from a change in GAAP is treated as an accounting estimate. So what that statement's a little confusing, so let me restate it here again. If I have a change in an accounting principle, that change is inseparable from the change basically from the effect of an accounting estimate, we then say that's now a change in accounting estimate, and it's going to require prospective application. If it was a change in an accounting principle, it would be a change. The change would be a retrospective application. So with that, that is the end of our video on accounting changes and errors. Thank you very much.